Hi, everybody, and welcome to Financial Thought Exchange from the CFA Institute Research Foundation. I'm your host, Larry Siegel, and our guest today is Tom Coleman. Tom is a professor at the University of Chicago, but he is kind of a Renaissance man. I met him when he had, not that many years earlier, written an astrophysics article, which he claims is his highest rated article, but we're not going to talk about that today. And then when I did meet Tom, it's because we were both at Ibbotson Associates in the 1980s. And as many of you know, Roger Ibbotson wrote one of the first pieces of research that the Research Foundation ever published, and it was called Stocks, Bonds, Bills, and Inflation. Tom, did you have a role in that?
No, I did not have a role in the original publication. I came on and I met you and I met Roger after that had been published and when you were in production of the SBBI database.
As I remember it, that's right, but you then did something on U.S. Treasury yield curves, which contributed to the same body of knowledge.
Yes.
Do you want to talk about that for just a few
Hello.
seconds? Because it is.
Yeah, so Roger coerced me and Larry Fisher into study of U.S. Treasury yield curves from 1925 to up to the present. And it was trying to uncover what the underlying, yield curve or term structure is. It turns out not to be as trivial as you would think because, in the 1920s and 1930s and in up through the 1940s, government bonds were some of them were partially tax exempt, some of them were fully tax exempt, and then starting in the 1940s, there were what we know today of the fully taxable bonds. So anyway, we did this large data project, and interestingly enough, that's I'm working on it again this evening. We're
I'm
meeting.
sorry. I I actually started my career with stocks, bonds, bills, and inflation, where I did have a role, and I may be ending my career with the exact same thing. Hope it's not the end, but I've agreed to be editor or some sort of participant in the 100th anniversary, which will be in 2026 of the beginning of the data, not the 100th anniversary of when Roger published it. It was about the 50th anniversary of that, I believe.
Right.
Thank you. Well, let's jump ahead to the present. You are, and you can fill in some of the origin story in between, but yeah, currently a professor at the Harris School of Public Policy at the University of Chicago. And in the intervening years, as I remember, you worked on Wall Street, had a hedge fund, did a great many different things for different organizations. What would you like to highlight before we get into the meat and potatoes here, which is really going to be two topics where I've learned a lot from you. One is inflation, and the other is inequality. And
So yeah, so I did my PhD at University of Chicago, which was where I met you and met Roger, and then taught for 4 years at Stony Brook. And then decided that, I was sort of better suited to working in the private sector, moved to Bank of Boston, working on derivatives desk, trading fixed income derivatives, swaps, swaptions, caps, floors, and so on. And did that for a number of years and just had a really immense fun doing it. It was a time when the industry was growing and we were figuring out how to price these different types of options. So American or Bermuda swaptions, we really had to figure out how to value them, and the option value for a bond behaves quite differently than the American option for a stock. So I worked.
certainly, you've actually made money for your Wall Street firm through this special knowledge of options, and that
Yeah, and
this was not. Yeah,
I want to emphasize that there's a part of it is specialized knowledge, part of it is, um, you know, figuring out things before other people figure it out. But part of it is just being careful and doing things writing the code, writing the risk systems, thinking about trading on a day-to-day basis, and just being careful to make sure you've got the day basis right, to make sure you've got the day counts and all of those little details. Moving from an academic setting to a Wall Street setting requires just a focus on a lot of the practical aspects and thinking in a very common sense way. And it's the combination of sort of the quantitative thinking together with the common sense and the practical, which um, I always really found valuable in my colleagues, and just really highly valued when I found colleagues that I could work with who had that combination of both the quantitative skills and the common sense.
Yeah,
Yeah.
I just wanted to mention that because many of the listeners, viewers today are familiar with the Research Foundation's output, your name is linked with two very popular books, both about risk. A Practical Guide to Risk Management, which was a Research Foundation monograph, and then a big thick book, which I think was some relationship to the foundation, but it is the kind of the Bible of risk management on Wall Street. But if you don't mind, I'd like to ask you about the article that we wrote together, which is on the fiscal theory of the price level. And as I said, you're interested in everything, so this interview may jump all over the place. But a theory of the price level is basically a theory of inflation.
Mhm.
And uh, why do we need a new theory of inflation? What's wrong with the old ones, monetarism and Keynesian theory, whatever you want to call that?
There's 2 or 3 answers to that question. So one of the answers is just money. I mean, so when was the last time you used cash?
I don't. It's been a while now, but I gave a $5 bill to the guy who parked my car.
Yes. And
Maybe
and
2 days.
I have sort of 20s sitting in my wallet that have been sitting there for months. And, you know, the this nature of money has changed from what it was in the 1950s or in 1900. Um, and even, you know, think about a bank account. You know, we now can sweep money out of our bank account into an investment account and invest it, you know, at the push of a button into a mutual fund, bond fund, or an equity fund. The whole nature of money with electronic transfers has changed dramatically. And so if you go back to Friedman's monetary theory, a really, truly successful and powerful theory of inflation that was based on money, but when
You mean
the day
money in the sense of currency plus bank deposits? It's
we well, exactly, that's always
currency, checkable. I'm forgetting the definition.
well, the definitions are difficult. Okay, the definitions were difficult in the 1950s,
Yeah.
but, you know, it would be currency,
Mhm.
it would be checking accounts, demand deposits, maybe savings accounts. But, you know, it was always a little difficult, but at least we had pretty much of a handle because everybody used cash and used cash pretty regularly. Bank accounts were the main way that the payments were made. But nowadays, with electronic payments, with Venmo, with Apple Pay, and with credit cards, right? The whole basis of MV equals PY, Friedman's quantity theory of money, kind of falls apart when we can't even define what money is.
Nobody has any money.
Nobody
They have assets, and they have my assets are mostly shares of mutual funds,
yeah. And
including
if you
money market
have
funds.
to, you can transfer it, you know, almost instantaneously. So the whole definition of money is really, if it was difficult in 1955, it is virtually impossible nowadays. So we need a new theory which, you know, allows us to think about inflation more broadly in the absence of money, something which works without having to tie down money. So that's number one. Number two is if we look at 2008, we look at 2022, those are a couple of really difficult episodes to explain with the existing either old Keynesian theory, new Keynesian theory, monetary theory. Those episodes contradict. If we look at,
What's so weird about those periods?
well, so, think about 2022. We had a burst of inflation. And the standard theory, whether it be monetarism, whether it be old Keynesian, new Keynesian, is you need to raise interest rates to counter that burst of inflation. But if we look at the time pattern of inflation, and remember, the Fed was really slow in raising interest rates. So if we look at the picture, and this is taken from some slides that John Cochran, who is, I would say, one of the premier, well, undoubtedly one of the premier authorities on the fiscal theory of the price level, but some slides he's put together, the inflation, CPI, took off in 2020, and the Fed did not raise rates until well after inflation just was bursting high. And then inflation started falling well before the Fed funds rate, the interest rate, rose above the inflation rate. The standard theories, uh, new Keynesian, old Keynesian monetarism says you need to raise interest rates by more than inflation to tamp down inflation. And boy, the episode in 2020 through 2022 just does not fit that at all. Um, what does fit it is a big burst of borrowing on the part of the government, a big increase in debt, and the fiscal theory is saying that, well, the inflation was a way of kind of inflating away the debt. It's a very, very old story. You have too
Can you
much
just
debt.
state the fiscal theory in a couple of sentences?
So yeah, so the fiscal theory is simply saying that government liabilities. What are government liabilities? What is the government liabilities are bonds, government debt, but it's also money. So it's a combination of money plus bonds. That's government liabilities. And those government liabilities have to be equated to the future the future um, cash flows that are going to pay back those liabilities. It's exactly an idea of like a share of IBM or a share of Apple. Okay, why?
You want to value a dollar, you want to use some kind of a discounting model to value a dollar the way you would value a share of IBM.
Exactly. Exactly. A share of IBM is worth whatever it is because of the discounted dividends. It's a net present value idea. It's the most fundamental idea in finance that there is.
Right.
That present value today is the discounted value of future cash flows. So why do people hold government liabilities? Because they expect to get some real value of coupons in the future that the government will extract from all of us, taxes, and use those taxes, number one, for government spending at the time, but number two, for paying back the bondholders. And the excess of taxes over government spending is what supports the present value, the value today of the government debt. And if the government debt is too high and people don't expect the government to raise enough revenue in the future to pay back, well, something's going to have to give. And what's going to give is inflation. You're going to
The
have
value of those liabilities, which is includes the dollar itself.
exactly.
Since inflation is a decline in what you can buy with a dollar, how I explain to people, we wrote the article together with a third guy named Brian Oliver. I said that the value of the dollar has to go down for things to equilibrate. But then people put up their hand and say, wait a minute, the government is never going to pay back this debt. It's running massive deficits, and they go out as far as the eye can see. How can the dollar have any value at all if what you're saying is right? And that's where I say, well, you ought to talk to Tom Coleman.
So, I think that's a real concern. But one of the things, you go back into history. You go back And, what is our debt to GDP ratio now? Something around 100 to 120.
Yeah.
What was it for Britain in the mid 1700s? Hey, the late 1700s. It was, so I can't remember the exact, 150, 180%. That is just huge. And in a financial system far less developed than ours. And yet Britain was able to sustain that kind of large debt because they were borrowing to fight wars, primarily with France at that time. But then during periods of peace, they would pay back and use the surpluses to pay back that debt. So the question is whether the question is not, are deficits today high, is whatever. What matters, that's not the question. It's not the question of whether deficits are high today. It's what's going to happen in the future. What is our expectation? As the wider investing public, what is our expectation for government policy over the next 20 or 30 years? Will the
Life
government
of a government bond.
and yep, will the government raise enough revenue? And by the way, the US has done it for 200 years. It's pretty good reputation.
Yeah, I mean, what the market's telling us, I guess, you tell me if I'm correct. Inflation has settled back down to 3 or 4%, maybe a little less. The market is telling us that yes, the government is going to pay back that debt, and yet when you look at their plans to pay back the debt, they don't seem to have one.
Exactly. But I think what the markets are telling us is that even if there are not plans that are written out or explained today, people have some confidence, some reasonable confidence that the government, that we, the people, will muddle through and figure out a solution to the debt problems over the next 20 or 30 years. This is not a problem over the next 2 years. Okay. But again, if that expectation changes, and it could change, on a dime, then then inflation bursts out. And I think that's what happened in 2021. There was a big increase in debt and little expectation that the government would pay back that increased debt. And so the markets, we the people just said, okay, we're going to devalue that debt. We're going to devalue it through inflation, through decreasing the value of a dollar.
We also experienced a shortage of goods at that time. The feeling that I had at the time was that this is not just fiscal, that we're getting a lot of inflation because there's nothing to buy. Is there anything to that?
Yeah, there's something to that, but I don't think nearly what is ascribed to it. Um, because if it were a shortage of goods, that's talking about relative prices of one goods, imported goods. There was particularly disruption in supply chains. Imported goods versus domestically produced goods versus services. And yet the inflation was a rise in the general price level, not a revaluation of one set of goods or services relative to another. So I think that this idea of deflating away the debt and that the inflation in 2021, 2022 was a more or less one-time increase in prices to devalue that large increase in debt. I think that's a better sustained explanation for the inflation. And it fits in better with, if we look at 2008, when
Please
we had.
expand on that because that's the other big, barnacle on our economic history in people's recent memory. And very few people can tell you that they understand what happened.
Yeah.
I call it a giant margin call, but I'm not sure if that's right.
So, and the contrast with 2008 is really interesting because there was, again, a large increase in government debt. But I think there were two factors that were different in post 2008 than in the pandemic 2020, 2021. In 2008, or 2009 and 2010 when the debt went up. Part of that debt was for solving problems in the financial system. And none of us are happy with bailouts of the financial system. But boy, we learned from the Great Depression that when the financial system starts to collapse, the whole economy just melts down. And so I think there was kind of a recognition, at least an implicit recognition, that the money that was borrowed was, in some sense, being well spent in trying to heal the financial system. So that's I think number one. Number two, and that which I think is equal or even more important, is what happened to real interest rates at that time. Real interest rates went way down from 2008 through 2009 and 2010. When real
One
interest,
point they reached negative 1.5.
yeah,
The TIPS yield was
yes,
negative 1.5%. So if you buy a TIPS bond, you're guaranteed a real loss in inflation adjusted terms
yeah,
of 1.5% per year over the life of a
life of the,
long term bond.
yeah. And remember, if you're discounting and your discount rate goes down, what happens? Well, the present value goes up. And so even without a change or an increase in the future revenue, the future tax revenue to refund and pay this, the present value of the existing payments increased quite a bit because of that fall in real interest rates. And that was, I think, a big factor which precluded or offset any potential inflation in the 2009, 2010 period. And in 2021, 2020, 2021, real rates were already close to 0. They didn't have anywhere to fall, and so that kind of backstop that we had in 2009 and 10 just really didn't bail us out in 2022.
Well, I would like to invite people more interested in the detail, people interested in more of the details, to read our article. And if you visit the Research Foundation homepage, you can find it under Tom Coleman, me, and Brian Oliver. The title is Puzzles of Money, Inflation, and Debt. It's a Research Foundation brief, and it can be downloaded or read free of charge to anybody who wants it. It's public facing. I would like to write more about that if you're ever available to waste a lot of time.
Well, I think we could do a good deal to update that because remember, we wrote that or the inflation really broke out in 21, 22.
That's
Um,
right.
So, and before Cochrane published his well, I won't call it magnum opus, but his textbook on the fiscal theory of the price level. So there's just been, I think, a lot of developments there. But let me just mention one more thing about the end of the German hyperinflation. So German hyperinflation, you read that, well, it's just a great story, a great set of stories, but the thing that is not emphasized or not covered as much or talked about as much is that inflation ended in a matter of something like 2 weeks.
It was weeks. But by the way, we're talking about 1923.
Right, right,
Not
1920.
there was another German hyperinflation, which was
Um,
less important
yeah, but this one
in
was
terms
so
of economic history. This
in
right
November of
was the big one.
1923, and hyperinflation had been running at, I can't remember, just hundreds of percent per month or per week. And over a period of about a week or 2 weeks in November of 1923, inflation went from hundreds of percent per week down to 3% a year or something like that.
Yeah,
Just incredibly, and it just ended. And I think the best story, the best explanation I've ever seen of that was the election over the summer, I think it was in August, of the new government and their change of policies and of their fiscal policies. The, the change of payments in for the passive resistance in the Ruhr, I think they laid off a large number of railroad employees, but they basically made credible commitments to uh, to have sustainable government spending. And then there was also an introduction of a new currency, but those two things, and primarily the fiscal restraint and reforms, I think were just the key issue. You know, the final thing on the German hyperinflation is, boy, I would never want to live through anything like that. It's just so disruptive. Keynes has a wonderful quote, which he ascribes to Lenin, about the best way to destroy the capitalist system is through inflation. So,
Yeah, I remember that. It seems to me that he's right, and that he may yet succeed. I really hope not. You recently returned, recently meaning in the last 10 years or so, to academia, went from Wall Street to the University of Chicago, where both of us went to school. And how did that come about? Why did you do it? And
well,
what are you doing there?
what I'm doing is teaching in the master's program at the Harris Public Policy School, and just having a wonderful time doing it. It's I must say I really enjoy the students, the research, my colleagues, and so on. But how I came back is just, it was an accident, and it just, it goes to show that, even our best laid plans, we don't know what's going to happen to our life. So I was pretty much, I was sort of semi-retired from finance, from running a hedge fund. And one day, my thesis advisor, James Heckman, called me up, and I talked to him. I saw him. I would see him once a year, but he called up and said, the Becker Friedman Institute is looking for an executive director. You should put your name in. And I said, Jim, I am so flattered. I'm really, that's wonderful thought, but that's a silly idea. I have no experience in academic administration. I've been out of academia. It's just not going to work. And 6 months later, there I was back at the University of Chicago. And so I worked at Becker Friedman, and then moved over to teaching full time at the Harris School. And that's been the story. And then getting into just really interesting problems. You know, as you said, one of the things I've been thinking about and working on is inequality.
What is your specific angle on inequality? Everybody talks about it, but nobody can really say what it is other than that other people have something that they don't have and they want it.
Yeah, so there's been just a big focus, and in some ways really beneficial, in other ways maybe less beneficial, on the top 1%. What my co-author and I, David Weisbach from the law school, we started looking more at the middle and the bottom part of the income distribution, and also looking at before versus after tax income. And it turns out that to really understand and think about income distribution, inequality, and so on, you have to dig a little deeply and think a little carefully about what we mean by income. And so some really innovative work by Piketty, Saye, Zuckman, which is well known. They started using tax data, data from income tax returns, and that's just wonderful because it's a very broad. It's basically everybody in the U.S. But one thing that I don't think was fully recognized at the time when they first started working with those data, with tax data, is taxes don't represent all of our economic income. In fact, taxes represent only maybe 60 to between 60 and 70% of total national income. So some of that is
I'm having trouble following that.
okay.
You mean only 60 or 70% of national income is taxed?
Well, okay. So
I just wonder what is 60 or 70% of what?
60 or 70% of national income is shows up on as income on tax returns.
Okay, got it. Yeah.
Okay. Now, part of that is people misreporting income, tax evasion. That's some portion of it. But some portion of it is simply in the tax rules. Okay. Personal income taxes do not cover the corporate income. Corporations pay their separate taxes, but corporate income is actually earned by the beneficial owners. That's
People.
you and me.
Yeah.
And that income has to be ascribed back to the original. But properly and correctly, that does not show up on personal taxes. Also, just tax rules can make a big difference. Prior to 1986, the corporate tax rate was lower. The personal tax rate was way high.
Right.
If you were a doctor or a dentist and you had a practice, you would incorporate that as a C corporation, pay taxes at the corporate tax rate, accumulate retained earnings, and then maybe when you retired or when you sold the business, take that as income in one way. But it would not show up on your personal taxes. Now, after 1986, with the 1986 Tax Reform Act, it changed. Personal tax rates went down. Now, if you were a doctor or a dentist, you had a practice, you would incorporate it as an S corporation, a pass-through entity, and all of those profits would get now show up on your personal tax return. No change in the underlying economics, but a big change in how that was reported as personal versus corporate tax income. And so the tax rules have an impact.
So what conclusions are you drawing in your work about how we perceive inequality versus how we should perceive it given access to the
So
right data?
I think there's two things. What I've been talking about leads us to be careful to think about what income we're measuring. And when we go and look at total a broad measure of economic income, the increase in inequality that we see from the 1980s, because listen, there has been an increase in inequality in the US since the 1980s. No question about it. But that increase in inequality, when you look at a broad measure of income, is much less, is much more reduced or is not as big as if you look just at tax income. Tax income is not giving us a really good representation of what's happening with economic income. So that's number one. But the other important thing that we looked at or that we uncovered when we started digging into these data is the importance of before tax versus after tax income, and in particular, taxes and transfers.
Yeah.
Uh,
And don't lower your voice so much on transfers. That's going to be the big story.
I think that the transfers are the big story because tax rates have come down in the 1960s. I can't remember. I mean, they were 80, 90% marginal tax rates.
I believe the highest was 91 or 93.
Yeah.
And
It was,
friend, nobody paid it.
nobody paid it. That appears to be the case. Nobody paid it. But also, as top tax rates have come down, looking at a broad range of data from a broad range of research groups, that transfers have gone up quite a bit. So what we looked at is a sort of, I would call it an effective tax and transfer rate. Let's say you get $100 before taxes. Now we're going to look at your taxes and transfers, and we're going to look at what you get after taxes and transfers. And the way we would normally think about it is you get $100 before tax, you get $80 after. So 100 minus 80, that's 20 divided by your original 100. That's 20% effective tax rate, tax and transfers. And that's the correct way. That's what we all think about. And that's going to be correct for the top 40, the top 20, the top 10, the top 1%. But if we
So
look
it's
at,
wage earners and professionals and
well, this is going to be wages. This is going to be business income. This is going to be finance, stocks and bond returns. This is going to be
retired people. Is that
Retired people, okay, retired Social Security is going to show up as a transfer. So you're before tax, and there's some really uh, reasonably subtle issues about how do you define before tax income? National income, the definition of national income does not, it excludes Social Security transfers. Personal income, a very, a closely related concept, personal income includes those Social Security transfers. So the measures, the primary measure we're looking at, or one of the measures we're looking at, is before tax income, which is wages, salaries, business, and so on, but not transfers. So you get 100 after tax and transfers, you get 80, that's a 20%. But if we look at the bottom half, not the bottom 10%, not the bottom 20%, but the bottom half of the US income distribution, take a guess what that tax and transfer rate is today. Okay.
Well, I wouldn't surprise me if you tell me that it's negative, but I
It's
don't know. I read the paper so long ago, I don't remember what you said.
it's negative, and it's pretty, depending on who you go and which research group. There's differences across these research groups. But the two biggest major studies, Piketty, Saye, and Zuckman on the one hand, and then Aughton and Splinter on the other, both of them agree on the qualitative aspect of a big fall. So if you look at Aughton and Splinter, it in the mid 1960s, that rate was about zero. And today it's about minus 40, 44, 45%. Piketty
So you're saying the bottom half of the population, just to be clear to anybody who's listening,
population.
faces a true tax rate, including transfers as a negative tax of about negative 40%.
About negative 40%. And
What does this tell? That's amazing. What does this tell us that might affect our behavior or the way we think about inequality?
it's saying that we need to be pretty careful. Oh, sorry, but before I answer that, let me just say the minus 40 is from this one research group, Aughton and Splinter. Another major research group, Piketty, Say, and Zuckman, they say only minus 20, 25%. Both groups, however, have the same qualitative result. A big dip down, or a decrease from zero or positive into negative territory. And what it says is, I think, two, I sort of take two things away from this, or three things. Number one, I was surprised. This is not what I had thought or known. And, I consider myself a pretty well informed economist. And, up until 3 years ago, when I really started digging into this, boy, it's not what I would have expected. So that's number one. Number two is that this increase in tax in transfers to the bottom part of the income distribution seems to have gone a long way towards offsetting the increase in inequality since the 1980s. And we can have debates, is that a good thing or a bad thing? But, I think it's really important to understand what is actually happening and what our tax and transfer, our total fiscal system is doing. And it does appear to be equalizing to a certain extent, maybe even to a large extent, the increase in inequality. The third thing, and I think this is just, it's not speculative, but I don't have answers to it, is what, if anything, but I would guess it does, what effect does this have on incentives for working? Yeah. And
Saying if you get in the bottom half of the income distribution, they're gonna help you. But
yeah,
it's not. I'd rather be. Actually, I want to be in the part of the income distribution that pays the most tax because it means I'd be rich. The,
right.
if you eliminate that incentive, we've got problems. But somehow I don't think we have.
Yeah.
But there may be a range of incomes where it does affect incentives enough to move the needle. If you're finding that, you should expand on that.
But this is something that I just haven't studied well enough, and I haven't talked to anybody who has studied it carefully. I think it's a really important open question. But one of the things that we really want to remember is that some of these transfers are things like Social Security. Ma-
Oh, yeah, that's right.
I'm not sure that Social Security is going to have a big effect on incentives for working because, in some sense, it's compensation today for retirees for the taxes, the Social Security taxes they paid earlier in their life. Uh,
Yeah, it's a very weird blend of a national pension program and a handout to people who have done their own handing, basically a hand back to people who were the source of the money that was handed out a generation earlier.
exactly.
You try to explain that to a person from Mars, and there will be people from Mars someday, I guess, and they will have no idea what you're talking about because it is so strange.
It is kind of strange, but it's that Social Security is probably not going to have a big incentive on a big effect on incentives to work. Other programs may have an incentive, but think about EITC, Earned Income Tax Credit. Earned Income Tax Credit is a large transfer program, but that is directly tied to employment. And so it's not clear to me that that program is going to have a big disincentive effect for working. So this is an open set of questions, and it's a set of questions that I've talked about, but and a number of economists, a number of my colleagues, um, just you know, we still do not have, I think, the good answers on these questions.
Well, this is great stuff. I would want to make sure that we save a few minutes. We've got about 8 minutes left to talk about your very long time interest in risk, financial risk specifically. We just had a guest, Allison Schrager, who talked about personal risk, people who jump out of airplanes and stuff like that. And the risks that you help manage are very different from that, but it's still risk. What you're shaking your head. What's on your mind here?
Well, I would say that they are the same kind of risks. They're in a very different environment, right? Jumping out of an airplane, skiing in the backcountry in avalanche terrain, those are personal risks
Right.
and risks that you may die. Uh, Taking on financial risks, well, it's the incentives could be quite different. If you're a corporate manager, then, the risks might be that you lose your job. If you're a hedge fund manager and it's your own money, well, it's your personal wealth at risk. Um, but I don't think the fundamental ideas of how to think about risk, of how to think about probability, of how to think probabilistically, I think those are exactly the same. They really carry over between the personal arena and the financial arena. It's
And
a
thinking
matter of
probabilistically is absolutely key to thinking, period. If you can't
yeah,
think probabilistically, you're probably not thinking very clearly because life is probabilistic. And
yeah.
maybe it's just because I've been in the financial field for so long or I'm just a nerd, but I think about everything probabilistically, and it gives you a different perspective on life.
And it gives you a different perspective on life. And it's a hard training ourselves to think that way is not easy. And there's shortcuts we can take, and there tricks and heuristics and so on. But I don't think it's something that we come to naturally, thinking probabilistically. But it is the right way to think about the world. Is what's the likelihood of rain tomorrow? And so I'm going to change my behavior, or I'm going to behave differently if the probability is 5% than if it's 85%.
The weatherman that got us to begin to think probabilistically because before weather forecasts started being reported in the way you just said, nobody ever talked about the probability of anything happening
Yeah.
outside of maybe some sports betting.
Yeah.
And now now we evaluate political situations that way, and
Yeah.
yeah,
But it's, thinking probabilistically, I think is really important because life is really a matter of a sequence, a whole set of decisions of trading off benefits, returns versus risk. Okay. And that's what finance is, risk versus return in very sort of stark terms measured in dollars. Personal risk, what jumping out of airplanes, skiing in avalanche terrain, those are still they may not be measured in dollar terms, but it's trading off risk and return, thinking probabilistically. But I think that the kind of tools and techniques, the ideas that we use for managing risk really carry over from one to the other. And, you know, one of the um, one of the quotes I love is by this, philosopher, Reicher, I think it's William Reicher. I should have the quote up. But he says that, we can't change luck, we can't, but what we can do is manage. We can behave in a way that takes the probabilities into account. We can try to hedge, insure, and manage. We can also, and this is really important, is not veer to be too conservative, not veer to the side of failing to take risks. Because, you know, the enjoyment of life is the benefits that we get. And we have to take risks. We have to put ourselves in situations where we can exploit beneficial outcomes and try to protect ourselves and hedge ourselves against those negative outcomes.
yeah.
And
And that's also what Allison said in slightly different, very different language. Is we just don't take enough risk, and she made the case that we've become chickens.
yeah.
Safetyism seems to be the national religion, and I'm not going to get started on that because we need to wind up. But I wonder if you have any last thoughts on risk that you'd like to share.
No, I guess, I mean, the only thoughts I share is kind of when I look back on my life. I'm really pleased with the risks I took in terms of my career and so on. But as Alice said, I wish I had taken more financial risks. So
Well, we all can look back on some financial decisions we've made and see how we might have done better. The big one I made is to not buy into the crash of 2008. I got out early pretty much, didn't lose any money in the crash, which made me feel like I was a genius. Well,
yeah,
I'm actually an idiot because the market fell by more than half. I didn't buy, and now it's gone from 600 and something to 6,000 and something.
yeah.
And I would have a lot more money if I had rebalanced all the. Oh,
But
you
let's
can't think that way.
exactly,
Right.
exactly.
The question is, what do I do now? And
Yeah,
I think that your books probably go a long way to answering that. I just want to give
yeah.
a storm.
I should say, the Research Foundation monograph and the large big book from Wiley. The first 5 chapters are the same between those two. They shared because the CFA and Wiley cooperated in the publication of those. And those first 5 chapters, I'm really pretty happy with. Um, First 5 or 6 chapters because it's how to think about risk. It's how to think about probability. And I just learned so much reading through the history of probability and reading through some different works on how to think probabilistically. It really, in many ways, changed my life. The second half of the Wiley book is all the technical tools of value at risk, copulas, and all of these other things. Really, really important. But boy, the most important thing about risk is it's people. It's all people. It's managing ourselves. It's managing risk. We need those mathematical, the quantitative tools, but they are not a substitute for thinking carefully about risk, thinking carefully about how to set incentives within an organization, of how to manage people, how to set goals properly, and how to build a robust organization, an organization which will be able to respond to unanticipated events. Because the whole point of risk is something happens that we didn't expect. And it's building an organization that is robust and able to sustain the kind of negative events that we know are going to happen.
Well, I wanted to tell everybody the name of the book. It's a practical guide to risk management. It is a free download on the Research Foundation website. It's also available on Amazon. I believe that it's print on demand, and so it's just a few dollars. And Tom writes extremely well, and so go read it, because those are the 5 chapters that I think everybody needs to read about risk. And I want to thank you very much for your generous contribution of time to our little show. And see you in Chicago.
For more information, please visit rpc.cfainstitute.org/research-foundation.